Welcome to Origins, the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I'm Nick Chirls, GP at Asylum Ventures, a newly launched early-stage venture firm celebrating the creative act of making startups.
And I'm Beezer, Clarkson, your LP co-host from Sapphire Partners, where we aim to invest in exceptional early-stage venture capital managers, both emerging and established franchise VCs. And Nick, it's so good to have you back again.
It's so good to be back.
Happy daddy.
Yes, I had 2 kids, twins. We haven't figured it out yet, but I'm back in the seat and feeling really good and excited to be back.
Wasn't the same without you, but we tried our best. Some of the feedback I've received is people actually like our banter. So I'm glad to be back and bantering with you.
We have an awesome lineup coming together for this year, and I'm really excited.
Yeah, and you picked an awesome episode to return on today. Our guest is Tomasz Tunguz, who is a GP and founder of Theory Ventures. He's an incredibly prolific and thoughtful writer on venture, has been for a long time, and really digging into it with Theory, which will be exciting to talk to him about. And prior to launching Theory, he was a managing director at Redpoint and spun out in 2023 as a solo GP, making him, along with many respects you, Vili, Sarah Gao, Eileen Lee, folks who have launched their own firms, to go head-to-head with the much bigger multi-stage industry giants. So we get to talk to him about the wonderful world of spinouts and how that's going.
Yeah, I've actually known Tomasz for a long time, since many moons ago when I was at BetaWorks. And he had just started his blog, actually. You probably remember this, but at the time there was like, I don't know, it felt like, blogging wars. There was like, everyone had a new blog. And Tomasz was actually different, very quantitative in nature, very much like an engineer's mindset. And he is technical. So it's been really fun and interesting to see him and his own career evolve. But he's been remarkably consistent with that blog too for, I don't know, it must be 15 years.
Which is a long time.
Yeah, really, really excited to talk about it. And then, obviously he's raised 2 funds in like pretty short order.
Yes.
I'm curious to hear your perspective as both as a LP broadly, but also an LP in his firm.
Yeah, no, totally. And he is really bucked the odds. Not surprising given who he is, but it has been a tough last 2 years for fundraising. You also defied all the odds. So you guys get to talk about how you managed to pull off what I bet a lot of people would love to hear the inside baseball on, to figure out it is still rough sledding out there for fundraising.
Well, to be clear, we've raised 1.
Correct.
We've got a long way to go before the next one. So yeah, he's clearly struck a chord with LPs and with founders. So I'm also curious to hear your view on re-upping too. Also curious how he's thought about his team and his org and raising capital around it. And I was poking around the website. There's actually not a ton on the website. So hopefully we'll get all the ins and outs and behind the scenes.
He's got a very specific, both, I would say, go-to-market strategy, which I think does differentiate him quite significantly. And it's sort of form-fitting function. Like he thinks a certain way as an investor, and he's built a firm that expresses that. And my belief, not being an entrepreneur or founder, is that it reflects the people that he then chooses, and that's part of how he wins. So unpacking all that with him is, I'm excited to talk to him about too.
Sounds great. Let's do it.
Okay. Tomasz, thank you so much for coming on the show. It's, I'm going to say, a personal privilege to have you here as someone who's been a big fan of yours publicly and privately, and now on the podcast and as an LP in Theory. It's really exciting to have this conversation. And I was hoping we could actually start with Theory and just dive right in the fact that we're seeing, and it's a hot topic in the venture world, the number of departures from top firms. I think the stat is over 800 first-time funds have been established since 2022, including yours. And I was hoping that we could just talk a little bit about why people you think are leaving. You can start with your personal journey on it, or just extrapolate a bit on what you think is going on.
Yeah, thrilled to be here. Thanks very much. I think a big part of it is, the industry's grown quite a lot. And so the total number of people who are in it is much bigger than it once was, right? To have firms that are 600, 700, 800 people now. We have firms that might be going public. I think you're seeing a maturation of the industry. I think it reminds me a little bit of what's happening or had happened in private equity. And so, the stat that I'd be curious is like, has the rate of departure actually increased, or is it just a base level effect where as the industry has grown, the end percent of people leaving, that percentage has remained constant?
I've tried so hard to get this number.
Have you really?
Yes, because I've had the same theory.
Beezer, you've got the data hidden away somewhere, I'm sure.
It's not clean, so we're cleaning. But exactly this, which is, it feels like a large number, but as a relative percentage, maybe not so much. I mean, the industry would have to have hit steady state at some point, because obviously the first decade doesn't count because there are about 100 venture capitalists. But somewhere when it started being about 5,000 or 6,000 individuals, anyway, I've had the same question, don't have an answer yet, but we'll see.
I think there's one part of it is we live in an environment where people are constantly starting companies and have new ideas. I think that's a big part of it. I think the other dynamic is it's really rare for people to remain in one company for effectively their careers, right? I mean, in venture, and I don't know private equity as well, but in venture, that's sort of the way that it was. Like you think about like Don Valentine starting Sequoia, I mean, he's there for like 50 or 60 years, right? And you don't see that in industry. Like you don't see somebody who works for 60 years at IBM or whatever the cliche is. And so now I think there's a sentiment there that's pervading. And then the last thing is the industry itself has fragmented, right? As it's grown, there's a need for many different kind of products. And so I think there's a customer segmentation VCs are market makers in a certain sense. We make a market between limited partners, capital, and then startups. And the LPs are looking for different kinds of financial products. And then startups themselves are also looking for different kinds of financial products. And so as we see opportunities, maybe we work in a larger, more established firm and we see an opportunity to capture a niche in a unique way, it's very exciting, particularly given all the inspiration that's happened around us to go and start something new.
I would add to that perhaps LP accessibility, I think has gotten like marginally better. Maybe still not as accessible as like maybe venture VC accessibility for founders, but like a little bit better. I mean, Beezer, you're probably a great case in point of like very public response stuff, easier to get to than maybe some LPs. Whereas like historically, I think like the GPs at those firms like held those relationships like crazy close to the vest. Maybe this is more a question for Beezer. And like, how do you square that with, in fact, like people have much shorter lifespans at firms now? Does that matter? Do you care? Like, does Tomasz in theory, like have to walk in and say, I'm going to spend the rest of my career at Theory for that to work?
I think stereotypically, yes, because one of the challenges you have in looking at a firm's performance is if the people shift, how do you then tie the historical success to future success? So the simplest thing is, oh, look, it's the same person. Yay, go team, right? And when they change, could be better, might be worse. But the reality, I fall into the same camp that you're thinking, Nick, which is it's unusual, highly unusual to see somebody doing the same thing in any industry for that long. So why do we anticipate GPs will do that? And the flip side, I'm just going to throw this nugget in there. The average CIO contract is 5 years. And some are shorter. So it's not even just GPs that switch around. The LPs switch around. And I've always been somewhat amused that people think LPs stay in place forever too. And the answer is no. So everybody's switching around. But I would be curious, Tomasz, if you went out and tried to fundraise and said, I'm going to do Theory for, 5 funds, which is probably a good 15 to 20 years with another, 100 years of back-end management on those portfolios. Do you think LPs would have been receptive or would they have been freaked out? Because I think some would be on both sides of that fence.
So, and we talked a lot about this. Like we talked about generational transition. We talked about key person risk, particularly within the context of a solo GP and Fund One. Many conversations around that topic. And this might be naive, but my perspective is as long as you can convey a plan that convinces an LP that the firm and the positions will be sensibly managed and that transition is slow and measured, you can instill a sense of confidence, right? So some firms have like planned retirement ages, right? That would be one construct. Or we have like promotion criteria. We have a 20-year plan for the firm in terms of like what it means for generational transition. And so communicating that at the beginning, I think was really important. So I think it's just about predictability. It's just like in any investment, right? Unpredictability creates volatility, creates uncertainty. People really don't like that. So if you take like the other view, which is let's look at private equity. A lot of these private equity firms went public, right? Like KKR and Carlyle. I think we'll start to see this wave happening in ventures, a blog post that's coming up this week. And there you have this notion of investing corporation. Like let's contrast that with how venture started, which is a bunch of people at lunchtime saying, I'm really excited about this company. I'm going to cut a 100K check. How much are you in for? How much are you in for? How much are you in for? That created the partnership. And that's kind of the way that venture started. And now we're getting to a place where we're starting to see the investing corporation, where compensation is not necessarily tied to the underlying funds. It's more a bit like a hedge fund where it's more cash bonus rather than carry. And there, I think it's, you have this like maturity curve where at some point as an investor in one of those funds, you're kind of just investing in the franchise as opposed to investing in a single individual. And there are individuals that are absolutely essential to those firms. Not that I wouldn't imply that, but the firm itself sort of endures more than the performance or the retention of any underlying individual or position.
We're probably going way off topic now, but I think there's an underlying belief there that whereas generational transfers historically in venture has been perhaps not as successful as many would like, that perhaps there's also been some like really good lessons learned over the last couple decades within venture, and maybe also using private equity as another place to look to, that maybe that actually ends up looking better in the next couple decades compared to the last.
Yeah, a lot more people I think have been through. I mean, not to say like even in the corporate world, these things are hard, right? Look, you look at Salesforce, like Brett Taylor, like that dynamic. You look at Intel and the transition of power there with Gelsinger. Not that I know him coming back, and whether that. I mean, succession is really hard. It's a really really hard thing, and I think especially when you have firms that are created around a single individual, the whole organization molds that person. When that person leaves, the organization needs to then like reshape itself.
Well, I'm going to recenter us a little bit around when you were launching Theory. What was and I don't know if you want to take it from the customer segment and how you were thinking about doing the firm or how you told it to LPs, because I appreciate it's the same core information. Sometimes the narrative gets expressed slightly different to the founder than to an LP because the audience is different. But can you tell us a bit about what you're doing and why you did it in that kind of context?
We ran Monte Carlo simulations on historical venture data and tried to figure out, okay, I read this book. It's called Demand for All Markets. And it was about this guy in the 1960s and 70s who started a hedge fund that produced like 25% net returns consistently for more than 25 years. And he worked with Claude Shannon, who was creator of information theory. And Shannon's like most notable work, or at least the one that I remember the most, is like information is surprise. Anyway, out of that statement, there came an investing philosophy that this guy named Thorpe developed, particularly around convertible bonds, and it was really successful. And what I took from that book was, if you start with the math and have the math on your side from day one with your business plan, you're in a really good position. And then you can kind of weather all markets, right? And when we started to raise Theory 1, the Fed had just raised rates 500 basis points. Like the stock market was falling pretty significantly. You had pretty enormous illiquidity within endowments and foundations, and people were trying to understand, what is the size of the private book relative to the public book? What's my overall venture exposure? How much is this worth? What am I doing in the secondary? So it's just a lot of uncertainty. And so the idea was, well, if we created a business plan in that kind of tumult, it should be able to survive lots of different market conditions. And so let's use math to get us to a place where we have the probabilities on our side. Like that was critical to me. And it starts with another story, which is, I remember I was attached to the hip of Jeff Yang, who hired me into Redpoint. 2008 or 2009, Mark Andreessen and Ben Horowitz came to visit Jeff and explained to him that they were starting a firm. And they laid out their plan and their strategy. I remember the room. I remember sitting in that meeting, but 15 years later, they've executed that plan pretty incredibly. And so that always stuck in my mind as long as you have an extremely clear business model, an extremely clear plan, and you stick to it and you let the compounding kind of take care of itself, you should be in a pretty good position. So it's really critical, I think, when we started, particularly during that moment in time, to have those two components to the strategy.
I can imagine LPs loved that. I couldn't underscore that enough. Was that your experience? Was that part of the secret sauce of being able to raise during tough market. I mean, holy cow, your first fund was a tough market to raise in. And I don't know, I mean, maybe the second fundraise was better, but if you could talk to us about the LP reception and what you thought really clicked, that'd be great.
I think the clarity was really helpful. And again, just being able to go into predictability. And this was not immediately apparent to me. I mean, I had a hunch that this might be the case, but it became clear to me after our first annual general meeting, the LPAC dinner, when some of the members of our LPAC, I asked them, like, hey, what do you think 12 months in? And they said, you did what you said you were going to do. And that's unusual. So I think as with like any investment, it's really about like instilling confidence. I mean, even with the startup, you meet a startup founder who's awesome, and then they show you a plan, and then they hit or exceed that plan. It instills a tremendous amount of confidence, right? In that, like, they were able to pick the right direction. They had the business plan. They picked the right, and sure, whatever, they'll deviate 5, 10, 15% because of the underlying market forces. But being able to execute your goals, I think, is really important.
If you were to summarize maybe what that plan looks like at a very basic level.
Great question. So we are a firm that builds highly concentrated portfolios. We put 12 to 15 companies in a fund, and we concentrate in those businesses. And we do that using a significant amount of research. So the goal is to invest in a small number of companies and just have significant positions in them, because venture capital is a power law. And so if we can have as much capital as close to the y-axis as possible, we should be able to generate venture returns. And we talked a little bit about, like, let's talk about LP segmentation, right? The way that I think if you're a multi-asset class limited partner, you have a public book, a credit book, a private book, you might have real assets. And on the very end of the risk and duration spectrum is venture. And that it's probably like single-digit %, maybe on the high end, it's a little higher, except for people who follow the Swensen School of Investing. And so that part of the asset of your book is meant to, when it hits, it really has to hit, right? Like that's the point. It's a high variance. It's one end of the barbell. And so we really wanted to create a strategy where that happened. We'd own significant fractions of the companies, and if we found a winner and lucky enough to partner with a generational company, that the multiple of the fund would be extremely attractive. And so how do we set up a firm to be able to do that? How do we create a business model to be able to do that? What is the underlying organizational structure to enable that to happen?
Let's talk about perhaps like lessons learned in Fund 1. So Fund 1 was, correct me, 230 million, I want to say. And you talked about, like, 1 year in, you're getting some feedback. You did what you said you were going to do. Where were the deviations?
A couple of things went the right way. I think we were really lucky to raise the fund target that we wanted to and have a great LP base. Thrilled to work with you as well. And I think the second thing, the team came together much faster than I thought. Like, if you look at the Fund 1 pitch deck, we thought we would be 5 people at the end of Fund 1, which was probably March or April of this, basically now. And we grew to about 7 within 6 months. And so we had a team.
And that was partners, junior people?
A friend of mine from Google named Lauren, we'd known each other for a long time. She was joined immediately, and she's an amazing COO for us. And then there was there's an investor named Spencer, a world-class athlete in 3 sports. He introduced me to a company that invested in at Redpoint, became a decacorn. He joined, and then we brought in a go-to-market leader from Looker, who I'd known for a long time, and he helps our portfolio companies grow. And so a lot of it came through relationships and referrals that way. I was surprised by how quickly the team came together, which was awesome. Other thing, ownership is really important to us, and we were pleasantly surprised that we were able to, with the model that we had, own a significant fraction of the companies that we were excited about. I think, challenges, building a brand, everybody says it, is really hard. It's really hard. It takes a lot of time. I remember at Google, we ran surveys on the ads, and someone has to see a message 7 times before they even remember your brand. And I was probably a bit optimistic there about how long it would take for us to build a brand and have Theory be a name that people remember. And we're extremely early on in that journey. Other lessons learned, we started in the co-working space. We just opened up an office in the Ferry Building in San Francisco about a month ago. It makes a huge difference. I think just getting a feel of people in the office, not to say that, we're there every day, but like the difference between a co-working space and your own office, I would have thought that there was no no true different, but it's real. Like having your own space is a really big deal.
You raised fund 2 pretty quickly. Curious what led to that decision. Is a bigger fund change in strategy? Was that based on some learnings from fund 1, or it was just you found 12 amazing companies in 18 months and we're ready to do it again?
We were really lucky. We had a lot of inbound interest, and we were meant to raise later than we did. So there was so much interest that we basically accelerated the process. And I think the fund size increase is just driven by the fact that we had modeled Series A's at a particular size, and they'd increased by 42% since we started the firm. And a lot of that is driven by AI. But so we just increased the fund size to be able to run the same strategy in a different environment. It's one of the things, like if you look at Founders Fund, one of the things I admire is they change the fund size as a function of the opportunity set, right? It's really hard to do. It's really easy to do on the upside, really hard to do and maintain that discipline on the downside. But if you're honest about your business model, it makes sense to raise the amount of capital that you need, plus a little buffer, of course. So I really admire that about firms that do that. We raised fund 1. We were about like 55% invested and reserved in fund 1 when fund 2 closed approximately. And so we'll start deploying fund 2 here soon.
There was a lot of demand. You felt like the strategy was working. And so you're like, well, we're going to do it in 6 to 12 months. We might as well just do it now.
Do it now. Exactly right.
God bless.
Well, you learn from startups,
Well
right?
done.
I mean, this is the advice that we give to startups is if you have people who are excited about backing you, capture that momentum and then go execute your plan.
LP market pull.
LP market
New
pull.
term.
Tomasz, you have a brand that you've built over 15 years. You have an amazing blog, widely read. Curious how you think about theory as a brand in that context. Like, is it Tomasz? Is it like, it doesn't matter if you have a brand and just how you think about evolving that over time? I mean, it sounds like it is an important feature of the firm.
Yeah, we have 5 core roadmaps. Market presence is what we call this, or branding. And it's absolutely essential. You look at like Coca-Cola's market cap, 55% of it is attributable to the brand, right? Warren Buffett says the only moat, the only sustainable competitive advantage is brand. So I think as we look to build a firm that persists and thrives, brand is absolutely essential. There is this tension. And I think it exists in venture and it exists in lots of other industries, particularly services industries, where there's a brand of a firm and there's a brand of an individual. And you can create both, and there are pathways. Like you can have a firm that's a collection of really great brands, or you can have a firm that's like institution first rather than individual first. I don't know. I've been thinking about this for a decade. I think ultimately firm brands are the sum product of a collection of individual brands that persist for long periods of time. And so you have to start with an individual brand. It's really important for us to invest in the rest of the team and have Andy write and Spencer speak and host events, and they create their respective brands within the ecosystems that they care about. And so we take that really seriously, knowing that it's a 10 or a 20-year investment with like no possible way of measuring ROI.
Because there's different models. There's like, there's the USV model, which is like they sort of all have their own blogs and Twitter presences. And then there's sort of like firm level content that they sort of aggregate around. There's like an Andreessen strategy where it's all part of the Andreessen brand.
Right.
Maybe the exception is like a couple of Twitter profiles. So like, could you imagine like bringing everybody's brand into the firm, or it's really like you have your own thing and that sort of at some point, that helps further the theory brand, but you do see them as sort of separate.
We want everybody to have a very significant sense of ownership inside of the firm. And so we want the development of a personal brand to align with the development of the theory overall firm brand. And I think Andreessen has done this really well. One of the things that's sort of taken me forever to figure out is marketing in venture capital firms is really hard, right? And I think marketing is probably the wrong word. So let's look at Andreessen. I think what Andreessen did really well, I remember when they hired Margit. Margit was the founder of the hottest PR agency, Outcast, I think it was called. And they paid her a market rate, which was like unthinkable at the time. I remember like the shock in the venture community at investing. I think they've done an absolutely exceptional job of building a brand. And the way that I distill it, I think there are 3 narratives that they've really talked about over the course of like 12 or 15 years, right? Like the first was the operator partner, founders backing founder. That was the first wave, right? Then there was the second narrative, which was software is eating the world, right? And that's like part of our parlance. And now it's around AI. And I can't remember exactly the moniker, but the fact that they had these three major strategic pushes that became iconic and part of, changed the way that venture worked, that's incredibly effective marketing. They changed the industry with that marketing, with that PR, with that story, with that narrative. And so I think if you do want to shape the industry, you need that kind of investment.
You need a belief to stand behind.
That's right.
It can't be like, hey, I'm a cool new Series A firm, which theory obviously is. But you actually need to believe something larger than that. And this is true for a lot of good forms of marketing, but like further that belief of which you're then tied to.
Marketing is all about values, right? Like Nike just do it, right? We had office hours with a wonderful CMO. Her name's Kadi Srinivasan. She was CMO at Dropbox and then at Lightspeed and also at Klaviyo. And we invited, I think, 15 different founders. We talked about early stage marketing. One of the topics that came up again and again was around counter positioning. So if you're an early company, you have to kind of pick a fight, right? You kind of have to say like the whole world thinks about this category in a particular way. And that's wrong. Let me tell you why. And the number of people who will pick up your phone call just to learn about why are you doing it differently? Like what is changing? What makes you so confident? Because people don't want to be caught off guard. That counter positioning in marketing is absolutely essential. It's true in venture just as much as it is in startups.
That's so interesting. So what's your counter positioning?
Our counter positioning is really just around extremely deep research, right? If you look at the public markets, the way the public markets have evolved, the vast majority of investment is passive, right? You look at the ETF. And if you look at venture, a very similar dynamic, right? Larger and larger firms are building indices. And that's a fine way of building and generating great returns. Our counter positioning is the opposite. We're very small, extremely research oriented. And so what we want to be able to do is pick as opposed to index. And if we can pick consistently, and if our employees believe that we can pick consistently, and we develop a brand that we can choose very small number of companies, we should have a viable business.
I want to go back to something you said earlier about using tech at its core at Theory. Can we unpack that? Because one of the things that I've noticed and I love about newer firms is, and this happens every cycle, always smarter on the new tech. It's always how the firms kind of advance and you see it. And I believe it becomes from your head, right? If the senior people starting the firm don't think it, it's not going to, maybe it's possible, but I've never seen it where an associate can push that kind of change up through a firm. So I'm curious what you mean at Theory about using tech at its core and however many secret sauces you can be happy to share or what the founders see so that they know to expect it.
We look at our portfolio companies. We had this one portfolio company entering Q4 of last year. Early stage, they had 11 proofs of concept. So 11 customer relationships where they needed technical support to see whether or not the customer would buy. And I remember having a conversation with the CEO and he said, I don't think we have the engineering headcount to be able to support 6 of these. So we're going to drop 6 and focus on those 6. And then at the end of the quarter, I caught up with him and he said, well, we serviced all 11. And how did you do it? Well, we bought AI, right? Let's just simplify it a little bit. And we bought AI and we were able to do it. And I said, okay, great. Like, what do you think that engineering headcount plan is for next year? So we're not hiring anybody. Like you hear enough of those stories, or like the Klarna CEO today was talking about how Workday and Salesforce are no longer part of the Klarna stack because they took a small team of engineers and replicated it. And so if that's the case in startups, like why can't it be true for AI? And then I think the hardest part within AI is you have to constantly step back and think about, if I were to design this internal process again from scratch, how would I do it? And you need somebody in an org who's responsible for that, who has enough gravitas and seniority within the org to be like, hey, Tomasz, like I know this is the way that you've been writing memos since you joined the industry, but like, man, here's this thing where we can automate it all for you. And so with the rapid pace of innovation, we need somebody to own that. So that's a really important part of the way that we think. There's another philosophy inside of the firm, which is experiments. So everybody's responsible for at least one major experiment per year. We expect 70% of experiments to fail. And the idea here is we should constantly be reinventing the way that we work, and it's everybody's responsibility.
Nick, do you have a head of AI?
I don't have we don't have an head of AI, but we very similarly think about experiments.
You do?
I actually do believe it is like truly the life force of a good, really any good organization, but also particularly venture capital firms. And I can just say from experience, like at the beginning of notation, insanely high level pace of experimentation that worked really well. I think it went down over time, unfortunately. With Asylum, super high rate again, and it's like codified into the values of the firm. Keeping that pace up over time is hard, but like truly critical. And we think about experiments as in like, we have a million different ideas every day, every week, every month. We think about them as what's the smallest version of this?
Mm-hmm.
So actually, I would even iterate on Tomasz's, like perhaps one big one is right, but actually lots of little ones all year, I think, is also important. And like, how do you design it so that it's really small and learn a little bit of something to keep going? I mean, this is true for any org probably, but I think it's also important for venture firms.
Are these experiments geared at finding the next great founder and winning the deal? What is the goal of these experiments as an LP? Curious to know.
Each team has a mission, and the experiments, they fall into 5 or 6 different in each one of those missions, right? So whether it's like market presence, investing, capital formation, right? Like all those things, the experiments typically fit within one of those portfolio company support. And so the idea is like, how do we further the firm and learn? And I think, Nick, you're exactly right. Like you're really just trying to learn and push. And I think the more that we do that, the more credible we are in market, the more we really understand the core underlying technologies, the limitations, where the opportunities might be. I remember at Google, like, the 20% project, like Gmail, right? Like the story of somebody deciding, hey, I really want to take a terminal-based email client, replicate it in the web, which is basically what Gmail is, and then leading to be, I think you need that kind of innovation. It drives people. It encourages them to have a sense of ownership. Again, going back, like ownership over the organization, ability to really reshape it. And then if you're a young person coming up within a firm, you can come up with an amazing idea. It could be an investment idea. It could be an idea along any one of those 5 roadmaps. But to have that avenue that's open to you for like a rocket ship trajectory is hugely motivating.
Yeah, I suspect one of the reasons you've been able to hire, had a similar experience at Asylum, is there's just a new energy, new venture capital firm, and there's an ability to help shape the firm over time. And it's a totally different value proposition than join big, settled brand firm. A colleague of one of my new partners at Asylum mentioned recently that the opportunity to hire for that person that wants to build the firm goes away really quickly. How do you continue to filter for those people that actually do have sort of an entrepreneurial mindset? Because at some point, theory will be theory 3 or 4, and the opportunity will be slightly different for a new person joining the firm.
Yeah, I think the bigger a firm becomes in headcount, the harder it is to change. I'll tell you a story. I went to an event where there were a bunch of VCs and there was a CEO of a foundational model company. He said, how many of you think that AI has improved about 1,000x in the last 2 years? And everybody raised their hand. And then he asked, okay, how many of you think that AI will improve 1,000x over the next 2 years? And most of the people raised their hand. And then he said, well, if that's what you believe, how are you changing the way that you live knowing that would be the case? How are you changing the way that you are working knowing that will be? Because like, I've been thinking like, it's really hard to, I can't really, like, I spent a long time like, okay, what does it mean for AI to be like 1,000 times better? Like, is the car going to drive itself? And do I have a job? And it's really hard to kind of imagine a world that you will live in, but don't yet live in. And so I look at a lot of these startups and I'm wondering, like, they can get to 100 million in ARR on like 50 people. How many people do we actually need at the steady state for a venture firm? Do we need 30% of what we might have done in the past? Could we retain a firm where, sure, like theory 7, we're still like 12 people, right? And there's an owner of each of these individual teams and people come in and out of the organization. And because they're the leader of that, maybe they continue to experiment aggressively. And maybe we can sustain that honeymoon period of ownership that exists.
What does that then do to inform where you invest today in AI? Just to go deep into let's ask all the stereotypical AI questions.
I think the skill that really matters is how do you ask the right question? Because I can kick off 10 browser tabs and have a deep research bot go and research architecture and robotics training and solar panels and modular nuclear reactors. And half an hour later, I can have 10 or 15 or 30 page papers on each that are probably like 80% accurate and good enough to be able to walk into a meeting and maybe not impress, but at least meet the expectations of founders in all those domains tomorrow. And so now the limiting factor is no longer, say, access to publicly available information. It's figuring out like where are you spending time. It's the same question of that every leader of any organization has, which is if I have 8 hours today or 10 hours or 12 hours today, what is the point of maximum leverage? And that's changed like very, very quickly. That point of maximum, it used to be, I think in venture, deep expertise in a particular domain. You knew all the people in the category, you knew all the different companies, you understood the nuances. And that's still important, but that point of leverage is changing. And I can't tell you what it is, not yet. We're trying to figure it out. But I think just recognizing that it is changing is really important and probably step one.
From an investment perspective, how are you spending your time? Like, where do you think the key parts of the stack are?
Okay, so the question we were talking about yesterday is like, what does the firm look like when there are 2,000 agents running every day? What does a venture firm look like when there are 2,000 agents? There are agents that are researching existing portfolio companies. They're researching the competitors to the portfolio companies. They're reading podcasts. They are listening to YouTube transcripts. They're extracting different names, and it's all going into some kind of a lead scoring system into a CRM that's all updating it. And maybe it's collecting and aggregating market maps so that you can identify when you walk into a meeting, you understand exactly the context of that meeting. That's a very real, we will see that in 12 to 18 months, right? Like, I don't know how many agents will be running, but it'll be well over 100 in a year. I think it's what Beezer said. It's about building deep personal relationships with people who you believe will create those next generation of companies and still having that network and then applying the judgment on where to spend time.
I'm so excited for your predictions for 2026. It's going to be madness. But how, speaking of predictions, how do you feel about your 2025 predictions?
I think the IPO market won. I was very aggressive there. I don't know if that will happen. There's a pretty significant backlog, but I really hope there's a lot of liquidity. I think it'd be a huge relief.
+1 for the whole LP industry.
We made other predictions like Google, I think has basically come out of nowhere from AI. If you think about where they were in early 24, they were materially behind. And we use a lot of Google models. They're really sophisticated.
I know we talk a lot about AI, but I'm grateful that the whole world is not yet just doing AI. What are the areas where you're finding interesting non-AI activity?
Yeah, we're spending a lot of time in the blockchain. When you look at stablecoins now processing, I think 3 times the amount of payment volume as Visa. That's like year over year. It's 5x growth. Remittances, payroll systems. You look at the major banks with the Genius Act. All of them, I think, will issue stablecoins. Bold prediction. It's not in 2025. It's like 7 of the top 10 U.S. banks by the end of this year will have a stablecoin. And so that will be the new rails of payment. That's really exciting. There's another category, which is a combination of AI and crypto. I think pretty significant opportunity there. I wouldn't say like decentralized inference or lower cost infrastructure is the way to go. But I do think there's the technology for like identity within crypto of I know that this person is Beezer, and she can prove that she works at a firm, but she doesn't actually have to tell me that. There's this whole world of what's called zero knowledge proof that I think will go hand in hand. I mean, just to make this a bit more concrete, one of the first themes that we researched was, could you build an ad network on a blockchain? And why in the world would you do that? There's a whole bunch of information that the New York Times and CNN know about you that they store on a file in your browser called a cookie. And that information is really sensitive, but it's also really valuable. And so rather than just destroying that, could you replicate it with the blockchain and build a new ad network? And so we think that's really important. I think in 10 years' time, every major software company will have a blockchain database inside of their stack to hold the most sensitive information, because it'll be less expensive to do that than it will be to pay for all the compliance costs across 170 countries, different data regulatory regimes. There's a bunch of opportunity there. And then the last category we spent a lot of time in is just in the world of data, databases, data visualization, the whole. We're a data firm. Everything that we invest in is powered by data. And so we want to continue to spend time there, because you can have arbitrarily large companies being built.
Thank you so much, Tomasz, for coming on the podcast. We've loved having you, and we look forward to talking to you again in the future.
Yeah, great to be with you both. Thanks very much for the invitation.
It was great to see you. Thanks for listening to Origins, the show where we discuss the venture ecosystem through the lens of myself, a GP at Asylum Ventures, and Beezer, an LP at Sapphire Partners.
And be sure to tune in next time for a bonus minisode where Nick and I unpack today's conversation with Tomasz.
You can find that right here in this feed. And while you're there, please rate and review the podcast. It's super helpful for other folks looking for venture insights to find our show. I'm Nick Chirls.
And I'm Beezer Clarkson. And we'll be back soon. Thanks for listening.